Welcome to Keys Open Doors. Today, we're breaking down how baseline interest rates work. You know, if you're gearing up to buy a home, whether it's your very first one or you're just jumping back into the market, you've probably noticed everybody is constantly talking about rates. It kind of feels like the financial weather, right? Some day that's perfectly sunny, other days there's a massive storm brewing, and everyone is just guessing what's going to happen next. But instead of just reacting to the news headlines, in this explainer, we're going to pop the hood, we'll cut through all the jargon, and look at the raw data to figure out what these numbers actually are, where they come from, and how they literally dictate the rules of the real estate game.
So let's dive into a pretty crucial question. Why should a future homebuyer even care about daily market data? Let's be real, it's super easy to think, hey, I'm not buying a house tomorrow, so what happens in the financial markets today doesn't really matter to me. But here's the thing. Understanding the baseline cost of borrowing money is basically step one to unlocking your purchasing power. Because in the real estate world, the price tag on the house, that's really only half the math equation. The other half is what it actually costs to borrow the money to buy that house. When you grasp how these daily numbers shift around, you start to see how they quietly expand or completely shrink what you can actually afford, way before you ever step foot inside an open house.
To make sense of all these borrowing costs, we really got to start at the bottom, the absolute foundation, and that is the bank prime loan rate. It's the baseline banks use to price consumer loans. Now let's translate that financial jargon. Think of the prime rate as the wholesale cost of money. Before a bank lends a single dollar to you for a credit card, a personal loan, or even a car, they look at this prime rate as their starting floor. It's one of a few base rates that financial institutions use to figure out exactly how much they need to charge us, the consumers. So if this foundation shifts upward, your everyday cost of borrowing usually goes right up with it. Let's look at a market snapshot to see exactly where that foundation sits. If we pull the data from the fourth week of May 2026, this baseline bank prime loan rate held perfectly steady at 6.75%, literally didn't budge a single hundredth of a percent all week long. And that's actually a really important anchor for the economy. When this number is holding steady at 6.75%, it tells us that the fundamental cost of short-term borrowing for the most creditworthy borrowers is stable. But as we're about to see, buying a house is definitely not a short-term endeavor, and your mortgage, it isn't directly tied to this specific number at all. So let's pivot a bit and look at how this builds into our main goal here, home ownership. Mortgages look at the long game. While that prime rate we just talked about heavily influences things like credit cards and short-term loans, a mortgage is typically a massive 15 or 30-year commitment. Because banks are locking up their money for literally decades when they give you a home loan, they can't just look at the short-term wholesale cost of money. They have to look at long-term economic thermometers to figure out the risk over a much, much longer horizon. All right, let's introduce the metric that actually drives your home loan, the 10-year Treasury yield. This is that long-term economic thermometer that heavily influences mortgage trends. To demystify this a bit, this yield is basically the return an investor gets for lending money to the government for exactly 10 years. Because the financial market looks at a 10-year government bond as the ultimate safe long-term investment benchmark, the mortgage market uses it as its compass. As a general rule, when this specific 10-year yield moves up, mortgage rates are going to follow right behind it. And when it drops, home loan rates usually get cheaper too. Now, if we track this 10-year thermometer over that exact same week in May 2026, we see a completely different story compared to the prime rate. On Tuesday, May 19th, it was sitting at 4.67%. By Wednesday, it dropped down to 4.57%. It held steady through Thursday and then ticked down just a hair to 4.56% by Friday, May 22nd. This is huge because it proves that while some baseline rates stay totally flat, the specific yields driving your mortgages are always a moving target. They're constantly fluctuating based on how investors are feeling about the future of the economy on any random Tuesday or Thursday. So the crucial takeaway here is this very simple reality. Time equals risk. The longer you borrow money, the more time there is for inflation to spike, for the economy to shift, or for some unexpected global event to completely shake things up. To compensate for all that future uncertainty, lenders and investors generally demand a higher return, a higher yield, when they lock their money away for longer periods of time. This whole concept of different maturities absolutely changes the baseline cost of money across the board. We can actually see that principle in action if we look at the market data from Friday, May 22nd, 2026. The one-year yield sat at 3.86%. But if we stretch that timeline out to a 5-year yield, it jumps up to 4.27%. And stretching it all the way out to the 10-year yield, it rises again to 4.56%. Basically, as the time horizon gets longer, the baseline borrowing cost gets higher.
This visually proves exactly why 30-year mortgages carry the interest rates that they do. They are built directly on top of these longer, inherently riskier time horizons.
Okay, so we've looked at the baseline numbers, we've looked at the daily yields, but what does this all actually mean for your wallet? I mean, you aren't trying to buy government bonds, you're trying to buy a house with a gorgeous kitchen island and maybe a nice backyard for some summer barbecues, right? Zooming out from the daily data, these broader trends in the 10-year yield are the invisible forces dictating the reality of your house hunt. Even a tiny shift of 0.5% in these baseline numbers can drastically alter what feels financially comfortable for a future homebuyer.
Here is exactly how those market shifts hit home. First up, your monthly payments. When the baseline rates go up, the interest portion of your monthly mortgage payment goes up, which means the exact same house suddenly costs you way more out of pocket every 30 days. Second, your total purchasing power. Because lenders cap how much of your income can actually go toward debt, higher rates mean you qualify for a smaller total loan amount. Your budget effectively shrinks. And third, available loan options. Different rate environments might make certain types of loans, like an adjustable rate mortgage, look way more appealing, or maybe a lot more dangerous, depending on the current baseline data.
Knowing all of this, how do you actually protect yourself from the daily noise of the market? Let's walk through 3 highly practical steps. Step 1. Track rate trends broadly, just like we did in this explainer today, so you understand the general direction the wind is blowing. Step 2. Build your savings. Honestly, the more cash you have for a down payment, the less you have to borrow, and the less you're at the mercy of borrowing costs. And step 3. Consult a pro. Get a licensed mortgage advisor in your corner early on. They can help you navigate these shifting tides well before you are ever ready to make an offer.
Now, before we wrap up, I really want to make sure you take this core reminder away from today's explainer. Everything we've talked about is general education. While the market sets the baseline floor, your personal rate depends entirely on your unique financial profile. Your credit score, your debt-to-income ratio, your employment history, these are the real factors that lenders stack on top of those baseline yields we looked at today. Many buyers just assume they'll get whatever rate they saw in the evening news, but in general, strengthening your personal financial health is absolutely the best way to secure a rate that actually works for you.
So, as these daily baseline rates continue to shift and move around, the biggest question isn't just what the market is doing today, it's what are you doing today to prepare your profile for tomorrow. Keys Open Doors, helping you unlock your path to homeownership. If this helped, like, comment, and subscribe.